The ever-increasing cost of education can feel like trying to climb Mount Everest, right?
Oh, absolutely. It's daunting.
And saving for it, especially when you start thinking about taxes. Well, it often feels like a puzzle with maybe some pieces missing.
Definitely.
So today we're strapping on our gear, so to speak, and taking a deep dive into the specialized tools that can make that climb maybe a little less daunting.
Good plan.
We're focusing specifically on how the tax system can actually be your Sherpa, your guide. We'll explore everything from the sturdy, reliable base camp of educational savings bonds.
The Series E ones.
Exactly. And then move on to the more agile, maybe high-tech climbing ropes like 529 plans. We want to show how each piece of equipment gives you a critical advantage in reaching that summit of affordable education.
Sounds like a valuable exploration.
Okay, but before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, examples, explanations we discuss here, they're all derived from the comprehensive accounting resources over at farhatlectures.com.
It's great material.
Yeah, so whether you're an accounting student, maybe a CPA candidate, or already a professional, you should visit the website for additional practice questions, video lectures, and detailed support to really reinforce today's topic.
Definitely worth checking out.
And a special thanks to Professor Farhat for providing this valuable material for us to dig into.
Agreed.
Okay, let's unpack this, starting with that foundation. Educational savings bonds, specifically Series E.
The classic choice.
You might wonder, why did the U.S. government even create these in the first place?
Well, it's pretty straightforward, actually. For decades now, the cost of higher education in the U.S. has just been skyrocketing.
Way faster than inflation, right?
Significantly faster. So the
Yeah.
government designed these bonds as a direct incentive, kind of a nudge,
A nudge to help people save for that ever-growing cost.
Exactly. To make it a bit more manageable. And what's the big aha moment with these Series E bonds?
The tax-free interest.
Well, yes, but it's more than just that. It's the timing of that tax benefit that's really interesting.
Okay.
Unlike a lot of accounts where you might declare interest every year, the interest on these bonds just accrues. It grows silently in the background.
Building up over time.
Right. And then only when you redeem them for qualified education expenses does that entire chunk of accumulated interest become tax-free.
Ah, so it's delayed gratification, but potentially a big payoff later.
Precisely. It's almost like a hidden tax shelter that I think many people overlook.
That sounds incredibly powerful, especially for long-term planning. But, with any government incentive, there are usually strings attached. Rules.
Always rules. Yes. There are conditions to make sure it's used as intended.
So what are the core requirements? What hoops do you have to jump through to qualify for this exclusion?
There are 3 key conditions, sort of like gatekeepers for the benefit.
Okay, gate 1.
First, and this is the big one, the money from the bond must be used to pay for qualified higher educational expenses.
So tuition, fees, that kind of thing.
Exactly. Not just any old expense, it has to be qualified.
Got it. Gate 2.
Second, the bond has to have been issued after December 31st, 1989, so basically from 1990 onwards.
So it targets more recent savings efforts.
Correct. And third, the bond must be purchased by someone who is at least 24 years old when they buy it.
Ah, okay. So that third rule is interesting. It suggests it's not really designed for, say, an 18-year-old student buying a bond for next semester's tuition.
Exactly. It's really aimed at someone like a parent, maybe a grandparent or a guardian, someone looking potentially decades down the road for a child's future education.
It really puts the focus squarely on that long-term planning aspect.
Precisely. The core purpose, like we said, is just making it financially feasible for families and individuals to save for college.
By offering that tax bonus on the interest earned.
Yeah. No taxes on the interest when it's used for education. That's the fundamental driving force behind Series E bonds.
Okay, but here's where it gets really interesting. Because, with tax incentives, there are always layers, rules, exceptions, and those infamous phase-outs.
Oh, yeah. The fine print.
It's never quite as simple as just tax-free, is it? It feels more like a tax obstacle course sometimes.
That's a perfect analogy. You can think of the tax-free status of Series E bond interest like passing through 2 gates. You should clear both to get the full benefit.
Okay, 2 gates. What's the first one?
The first gate is the income limitation. This is tied specifically to your modified adjusted gross income, or MGI.
Right, MGI. That comes up a lot in taxes.
It does, and this is where the phase-out comes into play. Basically, the tax-free incentive isn't available to everyone equally. It might be partially or even fully lost, depending on your income level.
So higher earners might not get the full benefit or any benefit.
Exactly. For example, using the 2023 numbers, and remember, these numbers can change each year. The phase-out started at $91,850 for single individuals.
And for joint filers.
It started at $137,800 for those filing jointly.
Okay, so if your income just crosses that initial threshold, you don't necessarily lose the entire benefit instantly. Is there like a window or a range?
That's a crucial distinction, yes. There's a defined range over which the exclusion gradually phases out. It's not an on-off switch right at the threshold.
How wide is that range?
For singles in 2023, the incentive was fully lost if your MGI went $15,000 above that starting point of $91,850. So the upper limit was $106,850.
Okay.
For joint filers, it was fully lost if their MGI exceeded the $137,800 starting point by more than $30,000. That puts the upper limit at $167,800.
Well, if your MGI falls within that $15,000 or $30,000 range.
Then you lose a proportionate share of the tax-free interest. The higher you are in the range, the more you lose. If your income is above that upper limit, the exclusion is just gone. Completely taxable interest.
All right, so that's gate number one, the income check. What's the second gate we need to pass through?
Okay, so even if you navigate the income gate successfully, maybe your income is below the threshold, you still have to pass through gate number 2.
Which is?
The redemption exceeding expenses limitation.
Okay. What does that mean?
What's fascinating here is this rule checks if the total amount you actually cashed out from the bond that includes your original principal and the interest it earned.
The whole redemption amount.
Right. It checks if that total redemption amount exceeds the actual cost of your qualified higher education expenses for that year.
Ah, so if you cash out more than you spend on tuition, fees, etc.
Exactly. If it does exceed the expenses, then only a proportionate share of the interest you earn can be excluded from tax.
Okay. That makes sense. You can't just cash out a huge bond, pay a small tuition bill, and expect all the interest to be tax-free.
Precisely. The government only gives you that tax break on the portion of interest that is actually used for your qualified educational spending.
That seems fair. Let's try to make this concrete with an example. The source material uses Emily.
Right. Emily's example is good for illustrating this.
Okay, so Emily cashed out some qualified savings bonds in 2023. She received $6,000 in total.
Okay.
Now, of that $6,000, $4,000 was her original principal, what she initially paid for the bonds.
Right.
And $2,000 was the interest she earned over time.
So pretty good return.
Yeah. But here's the thing. Her actual higher education expenses that year were only $5,000.
Ah, so she redeemed $6,000 but only needed $5,000 for school costs?
Correct. She cashed out $1,000 more than she technically needed for those qualified expenses.
Right. So that second gate, the redemption exceeding expenses limitation, kicks in immediately, even though she earned $2,000 in interest.
She can't exclude all of it.
No. We first have to calculate the portion of that interest that actually relates to her $5,000 of qualified expenses.
How do we do that calculation?
You take her qualified expenses, which were $5,000, and you divide that by the total redemption amount, which was $6,000.
Okay, 5,000 divided by 6,000.
Right. That gives you a ratio, or a fraction. You then multiply that ratio by her total interest earned, which was $2,000.
So $5,000, $6,000 times $2,000.
Exactly. And that calculation comes out to $1,667.
So that $1,667 is the maximum amount of interest she can potentially exclude.
Correct. That's the maximum before we even consider her income level, her MAGI. Because she redeemed more than she spent on education, the remaining $333 of interest, $2,000 total interest minus the $1,667 potentially excludable, is immediately taxable. No questions asked.
Wow, okay, so that's the first haircut right there, just based on how much she redeemed versus her expenses.
Yep, first limitation applied.
And then on top of that, already reduced amount of $1,667, we have to bring in the income phase out, that first gate.
Exactly. Now we layer on the MAGI check.
So what does this all mean for her $1,667 if we factor in her income? Let's follow the example.
Okay, let's assume Emily's modified adjusted gross income is $100,000 and she's filing as a single individual.
All right, $100,000 single filer. And the 2023 phase-out for singles started at $91,850, right?
Correct. It started at $91,850 and was fully phased out at $106,850.
So her $100,000 MAGI definitely falls within that phase-out range.
It does. Now we need to figure out how far into the range she is. So we take her $100,000 MAGI and subtract the starting point of the range, $91,850.
Okay, $100,000 minus $91,850. That's $8,150.
Right, so she is $8,150 into the phase-out range. Now remember, the total width of that phase-out range for singles is $15,000.
Got it.
So we calculate the percentage of the range she's in by dividing how far she is into it, $8,150 by the total width of the range, $15,000.
$8,150 divided by $15,000.
Comes out to approximately 54.33%.
Okay, 54.33%. What does that percentage mean?
It means she loses 54.33% of her already limited, potentially excludable interest of $1,667 benefit.
Exactly. The source material calculates this out and shows that after applying this income phase-out percentage, Emily would be only limited to $905.73 of tax-free interest. Wow. So she started with $2,000 in actual interest earned.
Yep.
Then it got cut down to $1,667 because she redeemed more than her expenses.
Right.
And then it got cut down again quite significantly to just $905.73 because her income fell within that phase-out range.
That's the process. A $2,000 interest gain quickly shrinks to just over $900 of actual tax-free income because of these two layers of limitations.
That's quite an intricate calculation. It really shows you need to pay attention. So the critical insight for listeners from this complex layering of rules is that with Series E bonds, the tax-free status isn't just automatic. It's very much a conditional benefit.
Absolutely conditional.
You face this double check. First, you can only exclude interest proportionate to your actual qualified expenses.
Yeah.
So the practical tip is don't over-redeem if you can help it.
A good advice.
And second, your income, your MAGI, has to fall below certain thresholds or at least be low enough within the phase-out range not to wipe out the benefit entirely.
Right. Miss either of those checks or fail them significantly, and you'll find that tax-free benefit rapidly eroding or disappearing altogether.
It really highlights that even these government incentives, designed to help, have very specific targets and rules you need to follow.
They definitely do. Precision matters.
Okay, that really drives home how those Series E bond rules can be quite intricate, even for something that sounds simple like tax-free interest.
Yeah, the details matter.
It's clearly a powerful tool, but one that demands, attention to detail. What if a listener's thinking, okay, that's interesting, but maybe I'm looking for something with a bit more flexibility or maybe higher contribution limits?
Good question.
What are some of the other power tools, if you will, in the education savings shed beyond these traditional bonds?
That's a perfect pivot, actually, because while those Series E bonds are sort of the classic foundational tool, the whole landscape of education savings has really evolved quite a bit.
Yeah.
The next major players, and honestly often the preferred choice for many people these days, are the qualified tuition programs.
Ah, the 529 plans? You hear a lot about those?
Exactly, commonly known as 529 plans. Now, a key difference right off the bat. These are offered by states, not directly by the federal government like the savings bonds.
Okay, state-sponsored. What's the core idea behind them?
The core concept is kind of like prepaid tuition, or maybe think of it as getting a potential discount on future tuition by contributing now. You're effectively hedging against those constantly rising education costs.
Locking in potential value.
Right. Now, a crucial point, and sometimes a point of confusion. Contributions you make to a 529 plan are generally made with after-tax dollars at the federal level.
Meaning you don't get an upfront federal tax deduction for putting money in, like you might with a traditional IRA or 401k.
Correct. No federal deduction on the way in. However, the big benefit, the real magic of the 529 is that the growth on those contributions, the earnings, the investment returns,
all that potential compound growth,
is completely tax-free at the federal level as long as it's withdrawn and used for qualified higher education expenses.
So the money grows tax-free, and you don't pay taxes when you take it out for school. That's huge.
It is huge. And here's an often overlooked advantage. While there's no federal deduction for contributions, many states actually offer their residents a state income tax deduction or even a credit for contributions made to their own state's 529 plan.
Oh, really? So you might get a state tax break on the way in.
You might. Not all states, but many do. So for residents of those states, it can be like a double dip of tax benefits, a potential state tax break when you contribute, and then all that growth is tax-free federally, and usually state-wise too, when used for qualified expenses.
Wow, that makes them even more attractive if your state offers that deduction. Definitely something for listeners to check for their specific state. Okay, so that tax-free growth is powerful. What exactly counts as a qualified expense for a 529 plan these days? It sounds like maybe they've expanded beyond just college tuition fees.
They really have expanded quite broadly over the years, which makes them incredibly versatile now.
Like what?
Well, obviously it includes the basics. Tuition and mandatory fees, books, supplies.
Standard stuff.
Right. But it also covers room and board, provided the student is enrolled at least half-time.
Okay, that's significant.
Very. It also covers necessary equipment like computers, peripheral equipment, software, internet access, things essential for study today.
Makes sense. What about students with disabilities?
Yes, expenses for special needs services for a special needs beneficiary that are incurred in connection with enrollment or attendance are also qualified.
That's great. I heard something about K-12 too.
Yes.
Mm.
That was a major change a few years back. 529 plans can now be used to pay for tuition in connection with enrollment or attendance at an elementary or secondary public, private, or religious school, basically K-12 tuition.
Is there a limit on that?
There is. It's capped at $10,000 per year per beneficiary for those K-12 tuition expenses.
Still, $10,000 towards private school tuition is pretty helpful.
Absolutely. They also now cover fees, books, supplies, and equipment for certain apprenticeship programs registered and certified with the Secretary of Labor.
Expanding beyond traditional college again.
Exactly. And one more significant addition relatively recently, up to $10,000 a lifetime limit per beneficiary can be used to repay principal or interest on qualified education loans of the beneficiary or even a sibling of the beneficiary.
Wow, so you can use it to pay off student loans too, up to $10.
Up to that lifetime limit, yes. So you see, a 529 can potentially support a child's entire educational journey, from kindergarten maybe, through college or an apprenticeship, and even help pay off some loans afterward. It's become far more flexible than just a college savings plan.
That incredible versatility really changes the game. It's not just for a traditional four-year degree anymore. It's a dynamic tool for a whole range of educational paths. Let's use another example from the source to show that powerful tax-free growth. Anna.
Okay, Anna's example.
Anna contributed $22,000 over time to a qualified tuition program, a 529, for her son's college education. By the time her son graduated high school and was ready for college, the fund had grown quite impressively to $32,000.
So that's a $10,000 gain on her initial investment just from the market growth within the plan.
Exactly, a $10,000 gain.
And that's where the core power of the 529 really shines when, say, $7,500 of that $32,000 fund was withdrawn and used to pay her son's college tuition.
How much of that $7,500 was taxable?
Zero. None of it was taxable.
Why not? Part of that withdrawal must have been from the $10,000 growth, right?
It was, proportionally. But because the original $22,000 contribution was made with after-tax money and the subsequent $10,000 growth was used for qualified education expenses, that growth component comes out completely tax-free at the federal level.
So the earnings just compound, untaxed, giving you a much larger pool of money available for education than if you'd saved in a regular taxable account.
Precisely. It's a significant advantage. However, there's a crucial note here about refunds or non-qualified withdrawals.
Okay, what's the catch?
If parents, say, withdraw money from a 529 plan and don't use it for qualified education expenses, maybe they got a refund from the school or just decided to take some money out, then the earnings portion of that withdrawal is considered taxable income.
So any amount withdrawn that's beyond their initial contributions would be taxed?
Correct. The growth part becomes taxable. And not only that, but typically that earnings portion is also subject to an additional 10% penalty tax.
Ouch. So the flexibility is great, but you really need to use it for its intended purpose, qualified education expenses, to get the full tax benefit and avoid penalty.
Exactly. Using it correctly is absolutely key. Okay, so we've talked Series E bonds, we've talked 529 plans. There's one more significant tool for education savings we should cover.
All right, what's the third one?
The Coverdell Education Savings Account,
Oh.
or ESA. Sometimes you might hear it called the 530 plan, but Coverdell ESA is more common.
Coverdell ESA. Okay. How does that compare to a 529?
Well, it's actually quite similar to the 529 plan in some fundamental ways, especially now that 529s have expanded their uses. But the Coverdell has always had a distinct advantage, which is now shared somewhat by 529s. It explicitly allows savings for both K-12 expenses and post-secondary higher education expenses.
Ah, so it was kind of the original K-12 savings vehicle in this tax advantage space.
You could say that, yes. It was designed from early on to cover costs at elementary and secondary schools, as well as college.
So that flexibility across all levels of education is a big plus, especially if someone is primarily focused on saving for, say, K-12 private school tuition.
Definitely.
Are there any key limitations or differences compared to the 529s that listeners really need to be aware of? Because 529 seem quite dominant.
Yes, there are some crucial limitations that really set the Coverdell apart from the 529 and frankly often make the 529 more appealing for higher savers or long-term accumulation.
Like what?
The biggest one is the contribution limit. Contributions to a Coverdell ESA are capped at a relatively small $2,000 per year per beneficiary.
Wow, only $2,000 a year. Compared to 529s, where contribution limits are usually set by the states and can be incredibly high, often hundreds of thousands of dollars over the life of the plan.
Exactly. That $2,000 annual limit per child is a major constraint for accumulating large sums.
Any other T limitations?
Yes, there's also an age limit for the beneficiary. Generally, contributions can no longer be made to a Coverdell ESA once the beneficiary reaches age 18, unless the beneficiary is designated as having special needs.
Okay, so contribution limits and age limits. What about the tax treatment? Is it like the 529?
Yes, the tax treatment of contributions and earnings is very similar to the 529. Contributions are not tax deductible at the federal level. They're made with after-tax money.
Okay.
But crucially, just like the 529, the earnings, the growth within the account are completely tax-free if the money is withdrawn and used for qualified education expenses, whether that's K-12 or higher education.
So, similar tax benefit on the growth, but with much lower contribution caps and those age restrictions.
Okay, so if I'm trying to weigh a 529 against a Coverdell ESA, given that $2,000 annual limit on the Coverdell, when might its unique features actually make it a potentially better or maybe complementary choice?
That's a really good practical question. It often comes down to specific needs and maybe control
Oh,
preferences.
so.
While the 529 clearly offers much higher contribution limits and those potential state tax benefits we talked about, the Coverdell typically offers the account owner more control over the specific investment choices.
Ah, so you might have more options than the standard menu in a state 529 plan.
Potentially, yes. With a Coverdell, which you usually open through a bank or brokerage firm, you might have access to a much wider range of investment options, individual stocks, bonds, ETFs, mutual funds, similar to an IRA. 529 plans, being state-sponsored, often have a more limited, curated menu of investment portfolios managed by the plan provider selected by the state.
So more investment freedom in the Coverdell, perhaps. Perhaps. And also, as you noted, it's explicit long-standing support for K-12 expenses, covering things like tuition, fees, books, uniforms, even tutoring for elementary and secondary school, without that $10,000 annual cap that 529s have specifically for K-12 tuition.
Right. The 529 limit is just for tuition, whereas the Coverdell qualified K-12 expenses are broader.
Correct. So for parents whose primary goal is saving for K-12 private school, especially if the costs exceed $10,000 a year, or they want to cover more than just tuition, the Coverdell might be a preferred choice, even with the low contribution limit. Or maybe they use both max out the Coverdell for the investment flexibility and K-12 focus, and then use a 529 for larger contributions.
Interesting. So it's really a balance, isn't it? Contribution capacity and state benefits with the 529 versus potentially more investment control and broader K-12 use with the Coverdell.
Exactly. It's about understanding the nuances of each and seeing how they fit your specific goals.
Okay, so wrapping this up, what does this all mean for you, the listener, as you consider your financial future or maybe your kids' or grandkids' futures?
Well, I think the main takeaway is clear.
We've covered that there are these valuable government and state incentives specifically designed to make education more affordable. They do this through tax-advantaged savings.
Right. From the Series E bonds with their conditional tax-free interest.
To the really powerful 529 plans with their tax-free growth and potential state deductions.
And the Coverdell ESAs offering investment flexibility and K-12 support.
Each one has its own set of rules, its own benefits, and yes, its own limitations. Understanding those nuances is really crucial if you want to maximize their potential.
Absolutely. And if we try to connect this back to the bigger picture, the broader concept in taxation,
Yeah.
this entire discussion about Series E interest, 529 growth, Coverdell earnings, it's a powerful real-world example of how understanding gross income exclusions is absolutely essential in tax planning.
Explain that a bit more.
Well, remember, the fundamental rule in U.S. taxation is that everything you receive, every dollar of income from whatever source derived, is generally considered taxable income.
Unless Congress specifically says it's not.
Exactly, unless it is specifically excluded by the tax law. These educational savings tools, the tax-free interest on bonds used for education, the tax-free growth in 529s and Coverdells used for education, they provide precisely those kinds of specific, valuable exclusions.
So they carve out exceptions to the general rule of taxability.
Right. And knowing where these exclusions exist and how to qualify for them is incredibly valuable for long-term financial planning, especially, as we keep saying, when you consider the ever-rising costs of education. These aren't just savings accounts, they're strategic tax advantages.
Strategic advantages. I like that framing. So as you, our listener, think about your own financial planning or maybe just your future learning journey. Here's a thought to leave you with. What's one area in your life, maybe beyond just education, where doing a little bit of deep diving into potential tax incentives or exclusions could make a really significant difference for you?
That's a good question. Retirement savings, health savings.
Could be anything. Perhaps it's something entirely different that has tax advantage options just waiting to be discovered. The key takeaway, I think, is this. Don't potentially leave money on the table or pay more tax than you need to, just because you might be unaware of the specific exclusions the tax code provides.
Well said. Knowledge is power, especially when it comes to taxes.
Definitely. And for more detailed information and to really solidify these concepts around educational savings and gross income exclusions, we highly recommend exploring the resources over at farhatlectures.com. You'll find additional examples, practice questions, and comprehensive explanations.
Great resource to continue the learning.
Absolutely. Well, that's all the time we have for this deep dive. Thanks for tuning in.